reason why I ask how many of you guys have an IRA or an old 401k is because in the United States, there are 100 million Americans that have an IRA or an old 401k, and that equals to $27 trillion that are out there in these kind of funds, tax advantage funds, tax saving funds, and a lot of people don't even know that they have it. So if you left an old employer or you left somewhere where you had or maybe don't even know that you have a 401k there, I encourage you to look into it because there are 100 million, and that's a lot of Americans that have old 401ks or IRAs that are just sitting there. So if you left an employer where you were there 5 years, chances are that your employer did a contribution to your 401k and it's sitting somewhere where it's not collecting any money. It's invested, but you haven't looked at it, or it's not something that you are even aware that is there. I encourage you to look into it. You can always call your HR department for that company that you left, and they will be able to either look into if you had a 401k or give you the company that the 401k is with. Because it's not going to be the company that you left, it's going to be with a third party administrator. So definitely look into it and make sure that you know if you have one. So a lot of questions that we get asked all the time is who qualifies for a self-directed IRA or 401k? And the answer is anybody that has an IRA, a SEP IRA, a Roth IRA, a simple IRA, a 401k, any of the employer-based retirement accounts that you're no longer with. So if you were in the military and you have a TSP and you left the military, that TSP is able to be transferred. And it's not only able to be transferred to a self-directed IRA or 401k like Horizon Trust, it can be transferred to anywhere in another wrong screen. What screen am I on? Oh, am I on the wrong screen? Why? Nobody told me. Which one are you guys looking at? Okay, there we go. Okay, so back to who qualifies. So anybody that has an IRA or an old 401k, that's who qualifies for these type of accounts. A self-directed IRA or 401k is a type of account where you can do alternative investing. So if you have an IRA or a 401k with Fidelity, that means that you can transfer something like that into a self-directed custodian like us. So it doesn't have to be a type of IRA, it just has to be an IRA or an old 401k somewhere else, and you can have a custodian like Horizon Trust that can have that account over. Now, what are the most popular alternative investments that our clients do? You can invest into anything that is not in the stock market. And we do have stock market alternatives, but if you already have it in the stock market somewhere else and it's performing, we'd rather you leave it there than transfer it into a self-directed IRA like ourselves. Because what people that transfer it to a custodian like us, they're looking to do alternative investments. So these are the most popular ones that we see, but they're not the only ones that you can do. So the first one is syndication deals. Most of the syndication deals that we're looking at are going to be in the real estate realm, but they don't have to be. So it's a group of people or a group of companies that come together and they put all of their funds into one, either LLC or a limited partnership or anything of that regard. And then they invest it into real estate or they invest it into something that's going to make money. All of those IRAs get paid back once that syndication is complete and they get a percentage of the interest that is made from that syndication. So a syndication is a really big one. A lot of people, you can invest into a syndication. You would do your own due diligence and make sure that you know what you're investing into, and then we would help you get through that process. Another big one is real estate. So as you guys know, real estate can be in all types of realms. It can be in all facets. One of the biggest ones that we see is you buy a property in your IRA, in the IRA name, and all of the rental income is going to come back into the IRA. The rental is going to be in the name of the IRA, and the bills are going to be paid within the IRA. So let's say you buy a property for $100,000 and your rental income is $1,000 a month. That $100,000 is going to go from the IRA to buy the property. The property will be in the name of the IRA, and the $1,000 of rental income will come back into the IRA, growing your IRA that way. So you bought an asset, all of the money that you're making from the asset goes back into the IRA. Let's say that the roofing needs to fixing and you need, $10,000 to fix the roofing. that roofing will come, I mean, that roofing cost will come out of the IRA. You cannot do it from your personal account. So anything that needs to get fixed or that is for that property will come out of the IRA, growing your IRA that way for with rental income and the asset that you put in there. All right, so I only have a couple more slides, so I'm going to go ahead and bring on our special guest so that he can go over his presentation, and he will probably have a better way of sharing because I thought I was sharing the right one, but it's okay. Okay, so private money lending, you can lend to somebody that needs the money, and all of those returns will go back into your IRA. So that's another popular investment that we have. We have crypto and precious metals. So if you wanted to invest into crypto, that's something that people do all the time right now, and it's very popular. So we have options for that as well. You have to have a platform that accepts crypto in an IRA, so we can go ahead and guide you through that. And then buying precious metals, a lot of people want to buy precious metals right now because entering, is it not? Was it still not showing? Okay, I can see it now. Are you guys seeing the most popular? Yeah. Okay. Well, my thing was not working at all. Um, okay. Precious metals. The thing with precious metals is that you have to have the precious metals stored in a depository. So what we do is we work with depositories that are compliant with the IRS so that we have you work with a broker or you work with the broker that sells the precious metals. And then those precious metals go get bought by the broker. We send the funds from the IRA to the broker, then the precious metals get bought, and then those precious metals go back into the depository. You cannot have the precious metals in your hand. The IRS does not allow that in alternative investments. So we make sure that we put those in the depository. Um, I'm going to go ahead and bring out our guest speaker. So our guest speaker is somebody that is. You can go to the last slide, please. I don't know who's okay. Okay. Shahar Plinner is the CEO and co-founder of Formations, sorry. Formations is a CPA firm. They do tax strategy and all things that have to do with tax planning for self-employed individuals. And I am very excited to have him. Shahar, can you hear me?
Yes, can you hear me?
Yes, I can. Thank you for
Hello, good
joining
morning.
us.
How are you?
Good morning. We are really good. So I will let you take over from here and then we will come back. I'm going to come back and do questions and answers with you. So you can take over for the next couple minutes and then I will be back.
All right, let me see if I can make it
It's one of
smooth.
those days, okay? So I
Yeah,
hope that you have a better time than I
I hope that it's going really
do.
smooth. Are we good?
I will let you know. Yes, I see your introduction.
All right. Let's move to the other slide because I cannot see myself too much. Like
It's hard, right? Yeah, but
it's
you
hard.
got
It's
it.
embarrassing. Yeah. So, but yeah, would love. Happy to be here. First, good morning. Thank you for having me on your call this morning. I am based in Seattle, so beautiful morning in Seattle, and happy to share with you today some great, tips and information about this coming tax season. So we are in February. Everything is kind of, kicking like in a hardcore. Tax season is here. Customers are getting, the requests to upload their documents. This is kind of the beginning. We start inquiry about what's going on in your 2025 kind of tax system. But what I want to share today in relate to the topic that you just mentioned, again, retirement plan, 401k, self-directed IRA, Roth IRA, traditional IRA, it's a whole world. And we as a tax professionals, we use the retirement world as a way to save tax. When we think about taxes in general, we think about, a couple of pillars. It's an holistic kind of, solution It's not a kind of a one dimension, help me kind of, to deduct a specific line item. It's a little bit more complicated. And as you mentioned, kind of the segment that we are touching, we are very enjoying kind of taking care of the SOHO, the small office, home office, the self-employed, the people that work for themselves, the W-2 employees that basically has potentially maybe a side business, rental properties, more than one source of income. And we think that, the beginning of the journey of your tax optimization start with your foundation, with the formation of your entity structure. So if you are an individual that, running your W-2 income with your employer, this is the one thing. But if you have some side business or have some other business opportunity, would love for you to understand the foundation of business entities, just because, again, when you seal that bucket, when you are actually in the right foundation, the right kind of entity structure, the savings are building on, and it can be thousands of dollars, sometimes tens of thousands of dollars. So when we think about, LLC, and you mentioned, LLC or S-Corp, as a tax saving engine, we just want to make sure that you understand that if you do nothing, the default for if you're not incorporated, the sole prop burden, you pay in addition to your state and federal tax, an additional 15.3% self-employment tax. As a W-2 employee, your employer observe half of it, 765, the Social Security, Medicare, the FICA taxes. But as a self-employed individual, again, the burden is 100% on you, 15.3%. So sometimes, again, this is the surprise that people kind of, going into their accountant, filing their taxes. I had either a small business, so actually I'm running my entire operation. I'm a real estate agent, I'm a financial advisor, I'm a plumber, I'm a fractional CFO, CMO, I'm an advisor. And then I made $100,000 and I thought that I owe, $20,000 in taxes. I'm in a 20% tax bracket, and boom, I owe $35,000. Why? Because I haven't planned, for the self-employment taxes. So we just want to make sure that you understand that entity structure, like an LLC file is an S-Corp, S-election, or S-Corp is the real thing. Some people are not aware about S-Corp as a tax mechanism structure, but this is the beginning of your journey. If you have a side job, or if you're running your entire operation as a self-employed individual, 1099, before we're getting into the retirement plan and the deferred compensation and how to manage your money and how to save more, the foundation of the business, kind of having the right entity structure, is super critical. So just to get for you as a teaser, if you go to your 2024 tax return, or if you go now into your 2025, if it's already in the make, and you get copy of your 1040, go to Schedule 2, Part 2, other taxes, line 4, self-employment taxes, see what the number is. If the number is tens of thousands of dollars, sometimes we see 15, 16, 29, $30,000, you just need to this is the red kind of Lego. This is kind of, the light bulb that will give you the indication that you're potentially overpaying on taxes. So the S-Corp, again, it's an election, it's you asking the IRS an approval to be taxed as an S-Corp, as a small corporation, subchapter S, and this is a great tax saving mechanism. By the way, if you already an LLC in 2025, the IRS allow you to do something called late S. They allow you to elect the S election all the way back to the beginning of 2025, means that, hey, if I'm kind of reaching into my tax preparation now, I'm working with my accountant, I have some self-employment income, I run some consulting income or real estate income. Again, not real estate rental. We'll speak about passive income at the moment, more ordinary income operation. And I feel that, hey, maybe my tax bill is too high, or I go into the self-employment tax line and it shows significant amount of money that I owe. Know that there is some solution. Again, late S selection, if you're already an LLC, something that we can use today. Just to give you some numbers, example for those of you that want to see something a little bit more kind of visual. So on the left side, you can see that if I'm a self-employed individual, I'm running, 120,000 of income into my business. 15.3% on self-employment tax can be, a little bit over of $18,000. And this is, again, just for you to know, this is on top of your federal and state taxes. If I'm moving it to an S-Corp situation, you can see that on the same scenario of $120,000, my tax liability is only $7,600. $7,600 compared to $18,000, again, a little bit over of $10,000, close to $11,000 in saving. And this is before optimizing my 401k, optimizing my self-directed contribution. This is before I'm paying my kids. This is before I'm paying my kids and open my kids a Roth IRA. So again, the world of retirement is work really nicely in collaboration with the world of taxes. Once the structure is ready, once we understand your business operation, this is where we get into the strategic planning, advising you what is the best plan to get out there from a retirement perspective. Again, we're using Horizon in order kind of to fund those retirement money and then help you to make more money on your money. So again, S corporation is one thing that you should be aware. And S corporation, again, by default, require the owner of the business to become a W-2 employee. And this is in a way what we want to achieve, because keep in mind that the corporate world, the Microsoft of the world, the Google, Facebook, Amazon, all of the corporate America already define a very healthy and efficient playbook for their W-2 employees. All of this, what you call corporate level benefits. I'm a W-2 employee, and now I can contribute to a 401k. The employer is making a match. I can sometimes do what you call post-tax contribution. I can extra, fund my retirement plan with some after-tax contribution. I have access to corporate stock. I have access to FSA, the flexible spending account, the HSA, health saving account. So as a W-2 employee, again, when Formations is running kind of our analysis, we want to make sure that you optimize your corporate level benefit. As an S corporation owner, keep in mind that you can do the same for yourself. So if I'm a W-2 employee, I'm running an accounting firm, I'm a tax consultant, I'm making $300,000, and I'm a W-2 employee, I can definitely participate in the 401k. And now my corporation can match, for me, it's about 25% of your W-2 compensation. And then I can do also some other advanced retirement contribution. And again, this is the reason we're here. Again, we're partnering with Horizon to give you the opportunity to get access to tax professionals. I'll give you a QR code at the end. Feel free to upload your tax return. If it's a 2024, we'll do a quick review, let you know kind of what they call the green, yellow, red, the things that we see that are great, the things that you may want to consider maybe changing, and the red flags, the things that we see either that you are maybe over deducting, and sometimes we see people kind of overexcited, to take deductions on the return, but most often we see actually people are shy and away from deduction. There's a lot of fear, we call it the FUD, the fear, uncertainty, and doubt by filing your return. I don't know what I don't know. I'm not sure how much I can kind of push the envelope. When Formations is doing the work, we're doing the work, in multiple dimensions. One, we are working for you, with you, to make sure that you optimize, your deduction and you only pay your fair share. On the other end, again, we have an eye into the agencies. I can tell you that the state agencies usually are more aggressive than the IRS. IRS is not in the best, situation in 2026. Lots of budget cuts and seasonal worker that is not equipped, to check most of the complexity on your return. I would not take advantage of that by abusing the system, but it's definitely not time to be generous. It's time to pay just your fair share and take every deduction possible on your return, no fear. So Claudia mentioned a couple of plans, a couple of minutes ago. We are very in favor of the solo 401k. The solo 401k just allow you to contribute higher amounts. So again, if your retirement plan is, $5,000 to $6,000 to $7,000 a year, no need to be too complicated. Go in the IRA direction. If you're in the 20-ish, kind of, 20, maybe $30,000 of retirement limit, the SEP maybe can be a great vehicle for you. But if you want to maximize, if you want to go all the way to the 69,000, 70,000, you have the cash flow, again, solo 401k allow you to be way more efficient, just because, again, the solo 401k plan, it's a plan that divided into two. It's the employee side and the employer side. On the employee side, again, as long as you have a W-2 income, as long as you have the income, usually there's no limitation on how you can get into the 24,000 pretty quickly. And then the profit sharing, the company, your business is matching. So again, we can dive on every subject if you approach us specifically and individually for you. But just know, again, that solo 401k way more tax advantageous than the SEP IRA. Claudia, what's up?
Yeah. I also wanted to go over a couple of other advantages that solo Ks have for the people that are joining for the self-directed part is the solo 401k has the option to take a personal loan against it. So if you are transferring $200,000 into a solo 401k to Horizon Trust or any custodian for that matter, you can take up to $50,000 in a personal loan and use it for anything. So if you needed to pay a tax bill and you wanted to use that personal loan, you can definitely do that. Also, it's not subject to UBIT tax. Shahar, do you want to go over what UBIT tax is and what 401ks are exempt from? Not really? Okay. So it's a tax that IRAs are subject to. 401ks are not. So I just wanted to go over that as an advantage for it.
Sure. Again, UBIT, it's again, you mentioned it before. Again, as long as you're using the funds within kind of the plan,
Yes.
you're not subject to any taxable events outside. But sometimes, again, you need to bring some money from the outside into real estate investment or into some other mechanism of investment that you're doing, and then it creates some taxable event. Again, keep in mind that the solo 401k it's also have the ability to have a Roth component. Some of you are in a lower tax rate relatively. Either some of you has, many deductions, or you can claim some the kids and the family, and by doing that, again, your tax rate is lower than on average. So sometimes, again, paying the taxes today allow kind of the fund to grow tax-free will gain a huge advantages for you. So again, we'd love kind of the fact that solo 401k has the ability to, service your bank. You can, lend money out of the account, but also have the ability again to play between pre-tax and Roth, which is after tax, pay the taxes today, let the fund grow tax-free forever. Again, some strategies that we see that are super cool for you to understand, mainly for those of you that have some real estate for investment. It's going really well with retirement contribution, and mainly a topic that we touch kind of briefly. It's the Roth conversion. So we fund your retirement. I've been disciplined. I've been a W-2 employee, or maybe I've been kind of a business owner, and I was disciplined kind of to fund my pre-tax retirement contribution. And then we get into a situation where I want to either reset, or I want kind of to convert some of my pre-tax into those tax-free vehicle, all of those Roth component that allow you kind of to edge against future taxation. So when we do that, when we do the Roth conversion, when we trigger, taxes by default, we create a tax event that we try to mitigate. So how do we mitigate it? We use, some code section that allow us to take relatively big deductions, year number one. Cost segregation is one of them. So when you buy and hold real estate for the long term, this is not for the flips. This is not for the wholesale. This is more about I'm buying a property and then I'm holding it for either the appreciation or for the longer term, maybe for, again, the tenants or short-term Airbnb to pay my mortgage so I can gain more equity within my properties. As a buy and hold, the IRS is required from you to take basically the depreciation deduction. And depreciation deduction, it's a straight line, usually between 27 and a half years to 39. Depends of if it's a domestic property, if it's a foreign. By the way, if you guys own properties outside the US, you can still claim the depreciation. But the depreciation is 27 and a half years. So if you depreciate 27 and a half years, usually it's a 3%, deduction every year. What cost segregation is doing is basically it's a study that you hire a professional that allow you to accelerate the depreciation. And usually by accelerating the depreciation first year jumped to 12, 13, 14, sometimes 15%. It's sometimes, again, 4 or 5 times the regular depreciation line. What it does, it basically reduce significantly, the taxable income in a specific year. So it's a great way of how to treat your real estate portfolio by having a deduction, a cost segregation, a code section that allow you to be way more profitable because you save so much tax, and if you add it into your overall calculation, your rental become very profitable. So if you just want to take the deduction, great. Cost segregation, it's a study. You get the report, you give it to your accountant. Your accountant will adjust your depreciation schedule from a straight line into 5, 7, 11 years of depreciation time. You get significant amount of deduction. You either take the refund, and now you have more money to invest in your 401k or in some business strategy, or basically take home and just have fun, or you can use it now to trigger some tax liability that will be taxed at a lower rate. So Roth conversion, selling some long-term capital gains, this is things that we see, as a full strategy that can overall, again, reset your retirement, your financials, allow you kind of to grow it tax-free. So this is just an example of cost segregation. Again, this is mainly for rental investment. Cost segregation cannot be applied into your primary resident. Cost segregation cannot be applied into flips or distressed property when I buy, fix, and flip. This is more on, again, buy and hold. But you can see that, if before we take the whole building and divide it into 27.5 years depreciation, you can see that if you have an appliances and furniture and carpeting and decor, we can depreciate that over 5 years. If you have some other office equipment, if there's any landscape or fencing or, some other stuff, you can do it over, again, 7 years, 15 years. Huge benefit of doing the cost segregation. Again, huge tax saving. And again, we are today, February of 2026. If you had properties, rental properties in use in 2025, you can run the study today in 2026 and go and apply it into your 2025 taxes. So the idea for the discussion today is everything that we are touching is still things that you can implement today. We call it surgeries because, it's like we're doing it now, but we take it backwards and kind of adjusting the return. Ideally, I want you to think already about your 2026 taxes. 2025 is done. We already did the planning, the strategy. We just need to file your tax return. It's more like a technical kind of activity, but I want you to think about your 2026. So if you think about buying a property, if you think about, investing in real estate, and if you don't have enough money into your self-directed IRA from some reason to run those ventures, and you need to buy the property as a taxable event, again, cost segregation is something that as a real estate investor, you must understand and you must, again, apply as long as it's a long term and you plan to own the property for the next 3 to 5 years. Claudia, I do not see the Q&A module from some reason, but I don't know if there's any
I see it.
questions.
I can go ahead and start the questions for you. Yeah. So somebody's saying, I look forward for the green light. I am part of formations. Please post the link. So they wanted the link to set up an appointment.
Sure.
Margaret is asking, when I take out business profit, do I have to pay taxes?
So again, depends on your entity structure. So sometimes distribution can be tax-free. Sometimes distribution will be taxable. So it depends on your situation and your entity structure. In most situations, you're paying taxes on all of your income minus your deductions, minus your expenses at the same year. But sometimes you're not distributing the full amount out. So let's say I made $100,000 in 2025, and I paid taxes on $100,000, but distribution-wise, I only took $30,000, which means I still have an access of about $70,000 into what we call my AAA account, into my account that I can distribute, later with no tax consequences. And then in 2026, we've made another $100,000, and I took another 30, and now I have $140,000, tax-free distributions. So in general, distributions are taxed, at the year that the money was earned, regardless if you took it out, which means if you took less, you actually can build some tax-free distribution from your business. But again, it's very dependent on your entity structure.
Mm-hmm. Perfect. Somebody's asking, is solo 401k available for solo entrepreneur or LLC S-Corp only?
No, solo 401k is available for everybody, and I
Mm-hmm.
think this is the perception versus reality. People feel that I only need to be a large corporation, or I only need to be in a specific structure. Again, there is some compliance, there is some requirement on a solo 401k, how to run it, and you need the right documentation from your business. But with an S corp, it's really easy, because you deduct it from your W-2 income. As a single member LLC or even a sole prop, you can still trigger a solo 401k. Again, you just need the proper documentation. And I can guarantee you that a solo 401k, even if it has a small amount of administrative costs, kind of, to keep the plan compliant with the Department of Labor, it's way better, again, than the SEP IRA for most of you. Again, the full-time self-employed or the full-time people that are making more than, $80,000, $100,000, the solo 401k should be one of your best friends.
Yeah. And for us to have a solo 401k here at Horizon Trust, you can't have any employees. So that's basically the only restriction. If you have employees, you don't qualify for a solo 401k. But there are other 401ks that you qualify with other custodians. So yeah, it's super simple. If you're running a business, you intend to make contributions, you qualify for a solo 401k.
Yeah. Again, just to close the topic on the cost seg, again, Nina came to us with a couple of rental properties that she was owning here in Seattle. And again, she's been a real estate agent for many, many years. She was an investor in real estate, but she heard about cost seg, but she never kind of understand the nuance and how to trigger it. And I think this is the beauty about formations. I think we're not just an awareness system that will bring, again, some education and awareness, and you don't know what you don't know. We'll make a very clear recommendation. We are type A system. We'll tell you, hey, this is what you need to do. It's not depends. It depends when we don't have the information. Once we have your tax return, once we screen and profile you, once we understand kind of your objective, once we understand your risk profile, once we understand a little bit more about what is your overall well-being goals, we can make a clear recommendation. And then by doing the recommendation, it's not done. We actually also do the execution. We know that cost segregation is complicated, and we know that you guys are busy. Only what you need to do is, hey, I understand, that I'm going to save $60,000. Help me to do that. We will run the study for you. We will share the study. We will educate you. We will make sure, that you understand the consequences. And then what we'll do, we will be the one that will update your depreciation schedule. We are the one, that will take the deduction on your return. So all what you need to say is, hey, I own a couple of rentals. Please run the study for me. And, if we find that the study is beneficial for you, there is enough savings for you to change the depreciation, we'll do it for you, and then we'll show you the impact. So we call it kind of the flywheel of awareness. We'll bring the awareness, hey, this is the things that you should be aware. We'll make the recommendation. By the way, solo 401k is great. By the way, you have a couple of employees, so we may kind of, to either exclude them or just to do some different plans. Or move them into a 1099, so they will be your subcontractors. But regardless, let's add the kids, into the payroll, and let's pay them, $6,000 or $7,000 into the Roth IRA, and let that grow tax-free. So it will be very recommended-oriented discussion. It won't be kind of, hand-waving and just the concept. It will be like, this is what you need to do, and if you join us, we will do it for you.
Very cool. Awesome.
Yeah.
Linda's asking, loan against the solo 401k is $50,000 max? That's correct. The loan against the 401k, they're asking for the max. It's $50,000. So it's $50,000 or 50% of your account value, whichever is less. So you have 100,000, it's 50. You have 70,000, it's half of 70. So that's how
it doesn't matter. And it doesn't matter if you work for Microsoft or Amazon or Google, and if your 401k has, $3 million inside, everybody is getting, the same treatment. So
Yeah.
this is the benefit, the same as all of these corporate, keep in mind that again, that the corporate world is fighting forever, with Congress about corporate benefits for their employees. Everything that those corporate level people are getting for themselves, this is things that you can implement in your business operation and more.
Perfect. Julie is asking, I want to 1031 into a new property with property A, then cost seg the new property B, to then offset the gain in the sale of another property C, capital gains depreciation recapture. Is this a reasonable scenario? You might have to
Yes.
reread that if I didn't.
Yes, it's a very reasonable scenario. And again, and this is and this is again, when we own kind of a real estate portfolio and we following kind of, the the buy, renovate, rent, refinance, and repeat. And then we use 1031 exchanges and cost segregation at the tail to make sure that we take the depreciation as aggressively as possible. And then when we sell the property, instead of selling it, exchange it. And then, you exchange it with a lower cost basis, or you exchange it without, the cost seg, and then you cost seg the new property. But once again, the depreciation reduced dramatically your cost basis. You can continue to exchange. And again, we're laughing at the word of tax. It's, it's an exchange, dead. Because when you're
Right.
dead, actually your kids, the beneficiary, have a step up in basis. So now they never need to pick up those cost segregation ever into their tax return. So again, there is always there is always something else possible. It's not for everybody. Again, if you're 30 years old, real estate investor, everybody live until 120 or more. You have maybe 90 years, to do some exchanges. But if you're a little bit older, in the 50, 60, and you feel that, again, this is the time kind of to start making some changes into your real estate portfolio, cost seg plus 1031 exchange, Claudia mentioned before, again, the self-directed IRA. Sometimes, again, we build a strong retirement plan. We use plans like defined benefit plan or cash balance, which what we call the 401k on steroids, the one that you can contribute $300,000 every year. And once we have enough funds, now we're playing with, again, post-tax and pre-tax, and tax-free, again, the different retirement plan. Again, so there's more than one solution. Our guarantee is, again, once we screen and bring the awareness, we'll make a very clear recommendation what's kind of the best path for you to own and continue to grow your well-being.
Perfect. Somebody's asking, what happened if property is already 27 years? I don't understand that. Maybe you understand that
If
question.
you basically already, depreciate your property in full, you've been holding the property for 27 and a half years, I don't think there's much on the cost segregation side. Maybe it's more about the exchange that you need to think about, because now, again, if you sell the property, you are doomed to recapture the full depreciation. So usually, again, cost segregation is really in its kind of best for the first 5 years of holding the entity. There is
Mhm.
enough depreciation forward. You didn't take much already kind of backward, so it lives kind of in its best 3 to 5 years. Again, new rentals for sure, all the way to 3 to 5, maybe 7 years. But if the property already been deducted for 27 and a half or 27 years or 26 or 20 years, probably there is something else possible for you than a cost seg.
Yes. Perfect. Jenny is asking, can the cost segregation study be done on a rental purchased more than 1 year ago? If so, can I use the cost seg to offset W-2 income in 2026?
100%. So again, this is what we kind of referred to a couple of minutes ago. If you run the cost segregation study today in February of 2026, and the property was in full service in 2025, you can take basically the study and run it into your 2025 return, reduce the depreciation. Again, you need to be a real estate professional. So once rental properties, the Schedule E, lose money because income is less than insurance, property tax, mortgage, management fee, and depreciation. If this is a loss, and you want to take the loss against your W-2, you just need to make sure that you are what you call a real estate professional. It's not a real
Mhm.
estate agent, it's a real estate professional. You need to perform, again, more than 750 hours a year and need to have more, 50% of your income should come from rental. Again, this is part of the nuance that on paper, again, I'm call it all of, I name it all of this, TikTok shit. Sorry for my language, but again, all of this clickbait. Again, you can deduct
Yeah.
Augusta rule, and you can deduct, cost
A
segregation, and you
Cadillac.
can, and whatever, and you can your pets and your kids and whatever. True, everything is true, but maybe not for you. So
Mhm.
I just want to make sure that one, again, as we spoke about the FUD, the fear, uncertainty, and doubt, you should not be fear or have uncertainty and doubt from the system. Taxes, it's a language, and you need to understand the language, and you need to be familiar. You don't need to be a tax expert like us, but you need to be at least dangerous enough to make those decisions. Same for the FOMO, the fear of missing out. There's a lot of information out there, mostly noise. Audit what you consume. Make sure that you don't consume all of the noise in the world. Try to make sure that you get a clear understanding and use professionals. Use professionals to translate and make sure that you understand what's there for you. Not everything is for everybody.
Absolutely. Okay. So the person that has a property for 27 years, he said that you mentioned there's something for everybody. He doesn't want to sell, but he wants to know if he can depreciate the rentals at all.
Yeah, again, if you
The same,
already own
yeah.
the property beyond the 27 and a half years, that's it. The depreciation is done. If you want to exchange it, again, you can do a 10-to-1 exchange. If you need a little bit more nuance, like, again, contact us, and then I'll review it with you quickly, and then we can, uh, um, um, come
Over,
with,
yeah.
with a strategy.
So I have two questions. One is, what are the best guidelines to qualify as a real estate professional? And somebody's asking, can this webinar count for one of those 750 hours?
So the second question is yes. Again, every education piece that you educate yourself and you participate count for those 750 hours. Keep in mind that, again, I've been doing taxes for almost or a little bit over, actually, 21 years. This is my 22nd tax season. Still having fun. The tax landscape is constantly changing, and with technology now and infrastructure, we can do such an amazing things. But keep in mind that, again, I've been in audits. Again, it's part of it's part of the game. You file thousands of returns. Some percentage are getting, being reviewed. Never been in the IRS audit on real estate professional. It's very hard to kind of for the IRS to document it. I think what makes it easy if you have more than one property and you do not have a management company. When you have a management company that takes, of the more of the day-to-day, the IRS can challenge, the fact that you're a real estate professional, or can challenge the fact that you're a real estate professional. So if you have a couple of properties or maybe three, and you manage it by yourself, and you always in the look for property, and you gain on webinars, and you gain some education, and you do some research, I think it's easier kind of, to maintain a log, which can be your outlook, for that. It's harder on the 50%. So usually we're doing it when husband and wife and one of the spouses is not working. So let's say, my wife, she's at Microsoft, and I'm kind of stay-at-home dad. If I'm bringing $60,000, $50,000 of rental income, it's by default more than 50% of my income. So if one of the spouses qualified, the entire household is qualified
Mm.
for the real estate professional provision. It's huge, again, because sometimes, again, when the rental is losing $20,000, $30,000 every year because of cost save, because of depreciation, because of one time, that we had to repair some stuff, and my taxes in a 30% tax, again, 30% on 30,000, it's another $10,000 of tax savings.
Awesome. Linda's asking, what is the cost base for the cost segregation? I've heard it's costly. When does it make sense for somebody to go through that?
So again, it's usually between, I don't know, $3,000 to $5,000 per study. If I can save you $20,000 on $4,000 cost, I think it's a no-brainer.
Definitely makes sense. Absolutely. Somebody asked, is a solo 401k the same as a self-directed IRA 401k? The
Yes
answer,
and no. So again, the self-directed and solo 401k is different terminology. Self-directed is the type of, the investment type, and maybe Claudia can define it a bit more, versus solo 401k, which is more of the infrastructure of the plan for the business. So it's more about, the plan structure versus what the plan can invest into,
Yeah.
if it
A
makes sense.
self-directed 401k or IRA is one that wants to invest into alternative investing. So the syndications, the real estate, somebody asked about tax liens, you can invest in tax liens with your self-directed IRA or 401k. Because the tax lien has to be bought on the spot, you have to have a checkbook LLC. And what a checkbook LLC is, it's an LLC that's owned by your IRA or 401k. We put all the money into that, and then you have management control of that LLC, and you can buy tax liens or anything that has to be on the spot. If you don't have it in the checkbook LLC, then you have to come to us. We have to require paperwork. It takes 24 to 48 hours. With tax liens specifically, that's not something that you can wait for. So a checkbook LLC will be something that you would be interested in.
Yeah.
Linda is
Just like
asking,
so,
yeah,
because we're running I just want to kind of quick recap. We spoke about entity structure. So LLC, S-Corp, again, really important, kind of the foundation of the business, because the right entity structure can get you, 10, 20, sometimes even more, $30,000 more of tax savings just by having the right entity structure. We spoke about costs again, 1031 exchange, for those of you that own real estate. We spoke about different retirement plan, 401k versus SEP, Roth IRA versus, again, traditional. We spoke about, again, things that you can deduct, like, again, maybe Augusta rule, which you can take some extra office expense. We spoke about, the fact that you can pay some, money to your kids. Again, there's some different tax codes. Again, the corporate level benefits, the HSA, the health saving account, which allow you to put another, a little bit over $8,000 for out-of-pocket medical expenses, the FSA, the flexible spending account, both for medical and for childcare. The government increased the FSA for childcare this year for $7,500. Again, childcare can be expensive, $1,000, $1,500, $2,000 a month for a kid, up to $7,500. Those almost like 3-4 months, of childcare pre-after school can be deducted today and get the tax savings. Another area that the government did a great job this year is increasing kind of your ability to deduct on your Schedule A, your ITMAS deduction. So one, keep in mind that the standard deduction increased for merit filing joint to a little bit over 32,000. The first tax bracket for merit filing joint 32,000, and for single people 16,100. Why it's important? Because if I'm paying my kids, I have 3 kids, and if I'm paying my kids 16,100 to each and one of them, I can deduct it without their need to pick it up as an income, because they fall below, the first tax bracket. So again, 3 kids, 16,000, it's about $48,000 each that I can deduct in 30% tax. I just saved $15,000 by paying, my kids some way of wage. And now again, they have to earn income so they can deposit into Roth IRA, take the money, grow it forever tax-free. Quickly about SALT, again, the state and local taxes increased to 40,000 and change from 10. So if you're in a high state taxes, again, New York, California, Minnesota, Arizona, you're allowed to, again, deduct more, and the pass-through entity tax. You can combine the pass-through entity tax, the PTIT. This is basically for those of you that are paying, state tax through your corporations. You can deduct both, the SALT on your W-2, and, if you're paying more than 40,000 on the state tax, because again, you're in a 10% tax bracket and you're making $1 million, you can do also some state tax deduction on your business return. Yeah, this is us, formations. By the way, just a quick correction. We're not a CPA firm. We have CPA in-house, but we're not a CPA firm. We don't want the title of a CPA firm because we want to be more on the consulting side. We want to move fast. We want to do some bundling of services. We want to do things that are more beneficial, for the end user without, again, the CPA scrutiny. We have all, solutions in-house, from tax and accounting, the taxes, the bookkeeping, the payroll, the filings. We're not doing any investment or any retirement. This is where we go to Horizon and we partner with them.
Yeah, and we have the information for you to get a hold of Shahar's team on the chat, or you can do the QR code. So definitely schedule your appointment if you have any questions for him and his team. What should they expect next? When they schedule the appointment, it's going to be they have
Yeah,
the
reach out. Again, as you can see, we're super passionate about taxes. You know, we're one of those weirdos that we're passionate about taxes. But it's fun. Again, you're always the kind of the good guy because you always kind of, find something else that can help our taxpayers and our customers and our community to save. So schedule a meeting. We'd love to see your tax return. This is kind of what we call the primary source of truth. We usually, again, the meetings are short, 15 to 20 minutes, maybe 30 minutes. Again, we can speak about taxes for 2 days straight, but we know that the attention span and it's a language, so we don't want to kind of overwhelm you with the information. Upload the return. If it's 24, we'll do a quick review. We'll let you know, hey, Claudia, this is areas that we like. This is areas that we want to dig in. This is things that you need to change, because you're losing some money. And then take it into your 2025. If it's already in the make, contact us if the 25 is ready. Just a second before you file and click, let us know. Again, here's my return. A few stories that we had about customers that just about to click and we found, again, the late S selection or the cost segregation and things that basically just a second before they filed, save them, $10, $20, $30,000. And if there is a good match, again, we'll propose you, an engagement to come and join the ride.
Perfect. Awesome. Well, this was great information. I'm seeing a lot of great feedback on the chat. If you want to schedule your appointment with Shahar's team, go ahead and schedule it with them. If you want more information on self-directed IRAs, I see somebody that needs information on a checkbook LLC, just schedule an appointment with our team with Horizon Trust and we'll be able to set that up for you. So Shahar, thank you so much for coming on. This was great.
Amazing. Happy to be here.
Happy tax season.
Happy tax season, and have a great rest of the week, everybody.
Have a great day. Bye.
Thank you, Claudia. Appreciate your time.
Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.